Before we begin, here's how to earn continuing professional education credit for attending this session. Gain valuable insights by attending the podcast, then complete the assessment test to download your certificate. To do this, follow these simple steps. Click on the link in your description to access the session. Create a free account and attend the podcast. After the podcast, take the assessment test and download your certificate. It's easy, and it's free. We highly recommend checking out our subscription. Let's get started.
All right. So now, in this transaction that we were talking about the fabrication shop, right?
Yes.
At what stage of the transaction was this credit discovered?
Well, it was right after the LOI, and it was a referral of a friend that they said, "Hey, I heard you do this," and so I had to educate them, help them understand.
Yeah.
But the nice thing was he had a ton of data for me to look at in terms of tax returns, and after doing it all these years, one of the things that's nice is for no cost, I can give a pretty solid estimate on the credit at the minimum with labor costs. Materials are always a little bit variable, so it's harder to put a number on it, but it can be really huge. We did a study they make Kevlar clothing that's the thin Kevlar, not because of all the scrap from making those clothes, what they are, those different items, all that scrap was materials cost. So the materials cost shot through the roof. I didn't see that coming. I just didn't, but it did. So it always depends on the material side, but labor side, they get an estimate. And then again, 4 years worth, depending on how you think, let's say you're doing 5 times EBITDA, although I don't like that number much, but I've never really liked EBITDA. But you're doing 5 times EBITDA. Okay, wait a minute. So this is 200,000.
It's a million. Yeah.
That's a million, 5 times EBITDA. That is a negotiation point.
Wow. Very interesting. It's this, you just got to have an eye for it, I guess,
Well, it's cash. And, we've gotten so obsessed with thinking about accruals and all these other things. This is a cash benefit, the best kind. It's cash.
Yeah.
And you've already paid taxes on it. Therefore, it's cash.
Welcome everyone to Accounting M&A Insider. I'm your host Saul, and today we're going to be talking about something very interesting because we're going to be talking about something that a lot of people don't immediately associate with M&A strategy, and that is R&D tax credits. And joining me today is Bob Stabell. Bob, welcome to the show.
Thank you, Saul. It's a pleasure to be here, and I appreciate you setting this up.
Absolutely. Now, to all the listeners who are joining in for the first time, this podcast, it focuses on the buying and selling of accounting firms in the professional service business. And when we talk about R&D tax credits, most people think of R&D tax credits as simply like a tax reduction strategy. But today we're going to discuss a lot about how these credits can actually change valuations, negotiation dynamics, and even the purchase price in transactions. But before we get that, Bob, before we dive into the deal mechanics, I always like to start with the story behind the expert, because I know when we were earlier talking, you had mentioned that your journey into R&D credits is actually a bit of a funny story. So I definitely want to know that. How did you end up specializing in R&D credits?
Absolutely. Happy to talk about it. So I was a finance major at Texas A&M University, and I had it all planned out to where my last semester, I would take speech communications and technical writing, and then interview for the rest of it. I went into my advisor because you had to be forced into those classes when you're graduating. And she said, "You're only 6 hours short of your accounting degree." And I said, and, I had a plan. Well, an hour later, she convinced me, well, no, she didn't. She made me take 2 more accounting classes. And then when, interviewing and resumes started, Coopers & Lybrand was the first one to come and say, "Hey, we want to bring you on board." So now here I am in the accounting world, passed the exam, spent 1 year in audit with Coopers & Lybrand and hated it. It's simply because every time you would go and ask somebody they were paying us. It's like, "Can I see this back up?" And they would look at me like I said something bad about their mother. Okay.
Yeah.
I just hated it. And an opportunity opened in special projects. And so I moved over there, and that included the original R&D credit, Section 199, what was beginning to be cost segregation and all the specialized incentives.
Mm-hmm.
And found my home in R&D. And so for 30 years became a subject matter expert in the area of the R&D tax credit, all of its ups and downs and flows and everything else. So that's my story, but it all comes down to my advisor refusing to do, let me go forward without taking those last two classes.
Oh
So,
my God. Oh my God. Very interesting. Very interesting. Now, when you started working in this area, did you notice what something like, what most CPAs were overlooking in the R&D tax credit arena?
well, yes, the R&D credit with accountants is a little bit elusive because I know plenty of accountants that are lawyers, but
Yeah.
I don't know many of them that are engineers, and you need all three of those. And I know you've had plenty of people talking about the credit itself on the show, but it's to understand that you do need those three legs and you need an expert because with the tax code changes, they happen often enough, but the R&D credit changes all the time based on case law, court law, and everything else. And you have to have all three. And I've had to learn how to specialize to talk to engineering firms because it is an entirely different way of thinking.
Yeah.
And especially, which I know we'll talk about the little hiatus that happened earlier or the last 3 years. Accountants are starting to catch up, but because of all the other changes in the one big
Yeah.
beautiful bill and tax season, it's something that's just being overlooked, and especially in the M&A side.
Yeah. Oh, yeah. I want to talk about that M&A side because that's something that I want to, that's something what this podcast is about, right? At what point did you start seeing this R&D tax credit show up in M&A situations? I mean, because usually when we talk about R&D tax credits, people think it's just like a strategic tax planning tool or a conversation for that. But when did you start uh, seeing this show up in M&A situations?
Well, it's very interesting because about 5 years ago, what you would see, depending on, in most cases, it was any kind of just, private investment strategy. Okay. But you would see groups that didn't necessarily want to take the credit because obviously some companies make money, some companies lose money. They do that on purpose. Okay.
Yeah.
And what I began to notice though was I ended up being contacted by a friend who's very big in M&A, and he knew I was doing this and that things had changed. And we'll tell this story. He was in the middle of a deal, and he asked me to take a look. And we ended up, because everybody does, they have their own calculator, EBITDA times 5, profit times 10, whatever. And he said, well, no, I want to know what the credits could be. And actually, that ended up being just a cursory glance, $370,000,
Wow.
which, because of that's cash back to the owner, because at the time it was a flow through entity, an S Corp, or no, it was an S Corp, flow through entity that went strictly to him. So immediately that became negotiation power for him to use to say, this is 400,000 in cash coming back, and it ended up shaping the entire deal to where he saved 400,000 on the purchase, and the client did get 400,000 in cash back. And that's when we
Nice.
kind of pivoted the firm and said, let's really help the M&A side of things while we're doing everyone else. So because we really learned how to focus, in some cases it may not help, but in most cases it will, one way or the other.
Yeah.
So
Yeah. Yeah. Very interesting. Very, very interesting. Because honestly, even when we spoke about this podcast, about doing this podcast, I was curiously drawn to it because I've never heard this.
it's
I'm not
always
sure if there are
something
other
that
people who do this.
Well, well, they will, but I don't think that they're experts in it like we are now. In just over
Mhm.
the simply because, and I'm not saying anything bad about the firms out there, but we really focus on, again, due diligence. Will it help you? Will it help just the owner? How do we finagle that? And I don't want to go through with you all of the CPEs that these guys have taken on the R&D credit when they know the basics of it, but it's understanding how to apply
Yeah.
in this particular stage. But they're all worried about, are the books accurate, right? Is the tax returns accurate? Are the bank statements accurate? And in the process of a deal, when people are scrambling to get all of these documents, I see it constantly overlooked.
Yeah.
And another
Yeah.
quick story, it's funny, there's another firm who's up for acquisition. Okay. Now, I thought they were a C corporation, which means the credits would stay with the corporation.
Yeah.
And so I said to the CEO, what you have to look at is that you can either get those credits and do, a dividend or cash out, whatever for you and the other owners, or they're going to keep them when they buy the company because the credits follow the C corp.
Yeah.
2 weeks ago, we find out that actually they were telling me it was a corporation and it was an LLC with
Oh,
two single members. Now, what we have is that, okay, now this money is yours. You want to get it before the acquisition because they could use the leverage against you that you're going to get those credits.
yeah.
And so we need to do it now. And so, sure enough, we're working on them to get them done by the end of this week. And so, that's going to be an extremely significant number for those owners. Then with the acquisitions, when they get acquired, they're going to be doing quite well. We'll just say that.
Do you want to earn CPE credit? Take this course of MyCPE ONE to earn free credit. Click the link in the description to get started.
Very interesting. As you're saying it, like I'm like starting to, look into the deals that, I have been a part of, and I'm like, I wish I'd known this earlier. Probably,
But
probably I would have.
yeah, but in fairness, because of the hiatus of what I call the hiatus of the last 3 years, any deal you did in the last 3 years, it probably wouldn't have made cash sense. And
Yeah.
I might as well explain the hiatus, but what happened was that depreciation, or excuse me, R&D expenses had to be amortized over. Now the government said a 5-year period, but it really
Yeah.
became a 6-year period.
Okay.
Because and so the first year you take the credit, you could only take 10% of your expenses, and then 90% had to be amortized. Well, as a
Yeah.
result, taking the R&D credit would cost you more than the 10% because your TI or taxable income would go up so much with that 90%. So a
Mm.
lot of small, medium enterprises said, "Hey, we're not doing any R&D." And so it was really just a thought. And, it really just kind of disappeared because it made no sense. And even in the third year of it, if you were lucky, you were at 50%. It
Yeah.
just about started to balance, but it was, again, you had to pay the firm, your accountant to do it. So about then it was balancing it out. Now that that's been repealed with the One Big Beautiful Bill Act, we now have the opportunity to go back to the 22, 23, and 24, capture those credits, and then depending on the buyer seller, what arrangement is made, they can then use those negotiations either way. Now, obviously, the seller is going to keep it quiet. The buyer is going to use
Yeah.
it for leverage in most
Yeah.
cases.
Yeah. True, true, true. More benefits to the buyer. Now, there was one story from our earlier conversation that has stood out to me. You mentioned about a deal where the R&D credit identified during the process ended up reducing the purchase price by about 200,000, I guess,
Correct.
So walk us through that deal, actually. What happened?
Sure. It was a fabrication shop and it was pretty small, but it was part of a portfolio of another client. They were trying to buy it. And what he ended up doing was he paid for our services to do the credits for the seller. And because it was a single member S corp, all of it went to him in cash. And because it was a real fabrication shops are really good qualifiers for R&D, even the small ones, simply because of everything they do is custom. It's a
Yeah.
prototype. And so a
Yeah.
lot of the materials labor come in. And so when he came with his final price, it was, for sake of example, I don't want to give away any details, but
Yeah.
originally the letter LOI was 1.2 million, and he ended up buying it for $1 million, and that was the final price of it. So he saved $200,000 and was very pleased with all the efforts. So what
Interesting.
people don't understand, they think of R&D as a deduction when it's a dollar for dollar credit. Okay. Now, depending on your tax rate, I just kind of rounded at 25%. The deduction is worth 25 cents. The credit is worth 75 cents. And you don't have to change anything you're doing in accounting to do it, to take it.
Nice. Very interesting. You know, um, this is actually a little bit off topic, but a lot of people think that R&D tax credits are specific to certain businesses, whereas when we talk about CPAs and accounting firms themselves, they think that a lot of people think that, oh no, this is not something that applies to them. What
Oh,
is your
very
take
much
on that?
so. The biggest problem is because of the word research in the title. So,
Yeah,
short version of there is a long version of this story, but we'll do the short version. When the credit was created in 1981, we had a problem in this country that we couldn't pay our high tech talent. So they were going overseas. And really, that's when expats were born. So what they created the credit for large companies. You pretty much had to have a patent to take it. And the documentation requirements were absolutely ridiculous. Plus, in the
yeah,
80s, it was an automatic audit, no questions asked. Well, fast forward to 2001, now we got a problem with the big businesses, big companies are doing great, but the small business boom, they can't hire technical talent.
yeah,
So in 2001, it became much more of a development focused credit, but that research word is still there.
yeah,
So when people hear it, they think, I know they've heard these on the podcast before, but they think of lab coats, microscopes, and all these other things. When in reality, if they're creating something, intellectual property, building custom items, of course, anything in manufacturing, engineering, software, all of them, because they're creating something, falls under the field of development. And that is one of the reasons why, when in doubt, ask, don't assume. And not that we're going to force credits on anyone, but I'm just saying that you have to know where the rules are and how they apply. We just worked with an engineering company just independently of the M&A, but 100K a year in credits. Boom, 4 years.
wow,
He 400K coming back to him.
wow,
And it's just all they do is engineering. But if you follow the case law, which all respect to CPAs is hard to do, that engineering is proved as a hard science. What they do is considered research. And if they spend 80% or more of their time in the practice of engineering, you could take 100% of their salary towards qualifying costs. And engineers aren't cheap.
yeah, no doubt. No doubt about that. All right. So now, in this transaction that we were talking about the fabrication shop, right?
Yes.
At what stage of the transaction was this credit discovered?
Well, it was right after the LOI, and it
Mm-hmm.
was a referral of a friend that they
Mm-hmm.
said, hey, I heard you do this. And so I had to educate them, help them understand.
Yeah. Yeah.
But the nice thing was he had a ton of data for me to look at in terms of tax
Yeah.
returns. And after doing it all these years, one of the things that's nice is for no cost, I can give a pretty solid estimate on the credit at the minimum with labor costs. Materials are always a little bit variable, so it's harder to put a number on it, but it can be really huge. We did a study they make Kevlar clothing that's the thin Kevlar, not
Yeah.
because of all the scrap from making those clothes, what they are those different items, all that scrap was a materials cost. So the
Yeah.
materials cost shot through the roof. I didn't see that coming. I just didn't, but it did. So it always depends on the material side, but labor side, they get an estimate. And then again, 4 years worth, depending on how you think, let's say you're doing 5 times EBITDA, although I don't like that number much, but I've never really liked EBITDA. But you're doing 5 times EBITDA. Okay, wait a minute. So this is 200,000.
It's a
Okay.
million. Yeah.
Yeah,
Yeah.
that's a million,
Yeah.
5 times EBITDA. That is a negotiation point.
Wow. Wow. Very interesting. Very interesting. It's this, you just gotta have an eye for it, I guess. You know,
Well,
it
it's
is,
cash. And, we've gotten so obsessed with thinking about accruals and all these other things. This is a cash benefit, the best kind. It's
yeah.
cash.
Yeah.
And you've already
Right.
paid taxes on it. Therefore, it's cash.
Access latest and trending CPE courses with my CPE One Unlimited Access subscription. Subscribe now.
Oh yeah. Oh yeah. Now, let's talk about the diligence side of transactions. When a buyers evaluate a business, they look at the revenue quality, client concentrations, and working capital as adjustments and so on, right? So, uh, where do R&D tax credits fit into the diligence process? When should the buyers start looking into this?
Really, any stage. I mean, we've had multiple calls of people that are starting a deal. And hey, what do you think this would cost? And, or what do you think the credit would be? All right. It can be from the beginning, middle, at the very end, or in two cases we've already done after it was done, but they hadn't settled. There's always that trail, right? After the deal is done, where, okay,
Yeah.
we got to close tax returns, we got to do all this. And then because of inventory adjustments and depreciation adjustments and all these other things, the credit can fit in at any point in time. So that's one of the nice things about it. It really can fit in. And I know I would use it if I was buying a company. Okay. Because it quickly, we just started on another company where this gentleman just wants out. I will tell you the purchase price is ridiculously low on the company. Okay.
Mm-hmm.
But with the R&D credit, it ends up being a zero transaction because that cash came or will be coming from the credit over the past 4 years. And then it's a done deal and they're negotiating that right now. So we're finishing up those
Nice.
numbers today, as a matter of fact. So
Nice.
that's a rare case. I mean, a no cash
Yeah.
transaction, but this one did happen. So
Wow. Wow. So like when like you said, it can happen at any point and you can take this into consideration. So are these R&D credits typically treated as an asset, or is it like an adjustment during the transaction?
it really just depends on how the cash flows. And in
Okay.
most cases, the cash flows to either the buyer or the seller. And frankly, in most cases, the cash flows to the seller. Okay.
Yeah.
However, let's say you're in a bunch of losses. All right.
Yeah.
The credits, then, if you know you're going to have, another deal, this gentleman was buying the company and then he was going to do a sale leaseback of the building to another party.
Yeah. Yeah.
Well, they had, huge losses, but those losses apply to the income, not a capital gain from that property.
Yeah.
So now he has accumulated with us credits in the tune of about 450, 500,000. When that transaction occurs, those
Yeah.
credits can go against the capital gain, which a lot of people just don't know when you do something like a
Yeah.
sale leaseback.
You make it sound very easy. Right.
Well, we do all of the work. It's just, there's a lot of people that don't know that that applies. And it's just because they're so used to seeing it on the tax return and as going against taxable income, they don't realize that it can be used by law against, a gain on capital purchase. And, buildings are always kind of in the middle of negotiations. We all know that. I mean, are we
Yeah.
really going to buy the property? Are we not? Are we going to do a sale leaseback?
Yeah.
There's always, a building somehow. If they're leasing it, maybe they want to buy it. You just don't know.
Yeah. You just no, I mean, yeah, true, true, true. I mean, like, like even irrespective of the business, that's one of the things. Okay, property. Let's talk about it.
Well, to
It's
me,
always
that's the most
important.
valuable asset is the real estate. But that's just
Yeah.
me.
Yeah.
Real estate's nice and safe. That's the way I view it.
Yeah. 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 True. 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 Now, I'm pretty certain, like you would probably also come across transactions wherein they are probably also they know about R&D tax credits and they're probably taking benefit of it. So how often do you see this? Like maybe you came across when this is happening, and when you dig down into it, you realize that they have been calculated incorrectly or they were not properly
Well,
documented.
I'm gonna
How
I'm gonna
often do you
talk
see that?
a lot, and I'm gonna talk to my old accounting buddies here for a minute because what has happened with firms, other specialized firms, is that obviously to increase their profits, they're using AI software. One company even integrates with your accounting system with AI. The problem is the credits will always be short. And the
Yeah.
reason why they will be short when you do that is because we still do it the old fashioned way,
Hmm.
transaction by transaction analysis. Give us the paperwork. We do all the work, but we don't want to miss that. And I've generally seen other firms, we are 30% to 40% higher in most cases.
Hmm.
Okay. Now then there's a
Interesting.
couple firms out there that are ridiculously aggressive, but that's also why we provide audit defense on everything that we do. If anybody wants to question it, we defend it. That's a huge cost to us. So as a result, we make sure it's 100% legal, ethical, and technically valid every time.
Well, not everybody would have access to, like a Bob Stabell during these transactions. So,
Well, hopefully
just
they
to,
will
like,
now. I'm good about answering my phone.
but like, just to give somebody a realistic dose of it, that if this was not taken into consideration, what kind of audit risk can arise for buyers after acquisition?
Well, and I'm really glad you asked that because that's a great question. Remember, I told you back in the 80s it was an automatic audit, correct?
Yeah. Yeah.
Well, what has happened over time is the rules were very gray.
Yeah.
Okay. And people do still perceive this credit as a gray area. It's really not, meaning that a lot of the case law has been settled. The
Yeah.
most recent case, most recent court case involving R&D involved a company that made t-shirts and apparel. Okay.
Okay.
It took $1 million R&D credit for these t-shirts and apparel. Well, that was completely unethical to do. And so they got smoked in court because they were buying shirts from China. They were screen printing them. Okay. But they were a large company, and this company said this will be a big fee. You have to look for the people that are worried about the number being right, not just a fee, because they got smoked in court, all of it denied,
Yeah.
as it should
Yeah.
have been. And we would have told you, hey, you don't qualify because
Hmm.
this is all you're doing. You're buying shirts from China, you're putting screen prints on them. That's not development. Now, if you're making t-shirts and sewing them and doing all of that in-house, there's of course manufacturing part of that, but it wouldn't be to the credit where, $1 million worth over 4 years. It just wouldn't be. And one thing we count on is for our team to be 100% honest about, hey, this isn't going to, this may not work for you.
Yeah, very interesting question. You mentioned that, in the R&D, the development part, because especially if we're talking about CPAs and accounting firms, it could mean anything, software as well. You quoted that. Now, as a CPA accounting firm, I'm not in the business of developing software. But with the advent of AI and the beautiful things that AI is doing, uh, I'm just letting all the users know that I'm not advocating that you should do this because AI is probably not there yet. But a lot of people are developing their own softwares. I've seen people now also, like use AI to develop their own softwares, which kind of like serves some purpose, and now they've got it commercially available in the market and they're selling it. I'm not sure how much successful it is. But if something like that were to happen, that you have developed a software using I don't know, maybe created an R&D tax credit software. I don't know. I don't know if
Yeah,
that's possible, but maybe they have, you
you're
know?
very close. And you actually quoted part of the two-part test. It's called the heightened software test. One, the
Okay.
commercially product is not available off the shelf. They don't want you to use any AI to create a new spreadsheet program. There's plenty of them
Yeah.
out. Okay. And then number two, that it has to be, creatively a new software, meaning there has to be a technical part of it that's just you can't see. Both of those are actually a little bit easy to prove. AI has created another gray area. And so our strategy is very simple. We're going to stay on what we know the law says,
Yeah.
software
Yeah.
creation. We're going to let a couple of firms get sued and in trouble with AI and then follow the case law. Because when in software companies, just like engineering companies, the labor is the main component.
Yeah.
Well, I mean, even if you're paying a monthly fee to use the AI, that doesn't count. But it's cloud computing, which does. But then also you're going to have to alter that software, test it, and because AI is moving so fast, there's so many
Yeah.
updates that you have to do just to keep up.
Yeah.
And so all of that qualifies. It's just that you're not paying really anything for the AI that counts, but under the law, the definition is pretty clear in software development that that's okay. And I know plenty of people that are doing just AI software they're creating for, I mean, trading, identifying M&A opportunities. I mean, I'm amazed at what I'm seeing happen. But to answer your question directly, yes, a lot of creating internal software, it's IUS, internal use software, will qualify for the credit, even for what I call soft companies, CPA firms, consulting companies, things like that. They may create their
Wow.
own. Well, they can take it as well. So.
Interesting. You might have just opened up the Pandora's box, my friend. I wouldn't be surprised if, a lot of accountants and CPAs listening into this podcast have now suddenly started to reach out to you. So
I hope
hang
so,
in there.
because one of the things we value is the honest relationship we have with the CPA firms we work with already. And I know that a lot of firms send, a pretty girl, drops off goodies, and all these other things. But the partnerships we count on is based on just pure honesty, What can we do? What won't we do? And yes, we'll back everything that we do. And that's what makes Think Tax a lot more special, I think, is just our devotion to pure honesty on everything.
All right. Now you mentioned that, for R&D tax credits, the area is very dangerous because it requires expertise of three skill sets. I think you said engineering, you got to understand the law, and you also got to understand you got to be a CPA. Yeah, the three
Accounting.
things, right? Yeah, a lawyer, a CPA, as well as uh, an engineering.
Yeah.
But I still see, like, like a lot of CPAs, they're like kind of like, moving towards it. They're kind of like, trying to get there, but not from a actual doing perspective. They're kind of like in the advisory role, right?
Right.
They don't really like, okay, let me sit down, they'll kind of just probably guide you that this is probably what you should be doing, and then they'll probably refer you to somebody like Bob Stabell, that okay, he's the guy whom I've partnered with, and Bob would probably, like take things over and he'll get things done for you.
Well, and a
That's how
lot of
it happened.
CPA firms started to try to create their own R&D practices right
Yeah,
before that Section 174 amortization rule happened. So again,
yeah.
there's this 3-year gap. And so now to try to restart one, it's not
Mm-hmm.
going to be feasible because we have a hard date. Right now, when you take the credits, if you take them by July 6th, it is a superseding return, not an amendment. So you
Mm-hmm.
put the R&D paperwork in, you can take elect 280C, which is the reduced credit, that lowers audit risk,
Mm-hmm.
and send them to the IRS and get your refunds. But after July 6th, it's going to go back to amendments. And everybody that knows when you amend returns, it was up to 3 years after COVID. It's down to about a year and a half to get your cash back now. And I'm seeing it come down very slowly, but here we are in tax season, right? So now all these returns are going to be processed. So I think it'll, go back up as far as those amendments, but the superseding ones, they're actually paying really quick. And so keep that in mind, please. July 6th, you may be looking at, I know everyone here is probably looking at the March 15, April 15 deadline, but you need to keep July 6th in mind for the benefit of your clients. I mean, it's 3 times as fast as amending those prior year returns. And you can even do a superseding return on 2025 by July 6th if you missed it.
Yeah.
So that's what the law says. But after July 6th, unless they extend it, we're all, it's back to the old way of doing things.
All right, all right. Now, you've spoken about, an example which was involving a $1 billion company, wherein the employee retention diverged significantly after a transaction. So what happened there?
Oh, if you took the ERC, it was either 21 or you went back and took the partial in 2022.
Yeah,
The rules state, and this is something people miss, I've seen a lot, if you took the ERC credit, a lot of people are saying you can't take that employee for the R&D credit. It's actually not true. If you got 26,500 for, say, an engineer under the ERC, you
right.
simply have to lower his salary by the 26.5, not take him at all. That's all you have to do.
Oh,
And it's funny, that was a big miss. We prepared ERCs for our clients for no
yeah,
charge because it was pretty
yeah,
simple, but we stuck very close to the number one test. Number
yeah.
two test we kind of avoided. But as you know, a lot of firms got ridiculously aggressive.
Oh my
That's
God.
why they're still held up, you know?
Yeah, yeah. I mean, it was crazy. I mean, the ERC mills, they kind of like, that put a lot of companies into trouble.
I
And I
used to
guess
call it
also because
1-800-ERC.com. That's what I called all of them. So I couldn't come up with anything more creative.
yeah, yeah, yeah. I mean, crazy. In fact, I mean, the pandemic had its own interesting cases. I don't want to talk about it now. It's in the past. So people claiming credits and then going on to buy their Ferraris and God knows what's not.
Well, I'll tell you, it's a funny story because obviously you mentioned that, and thank you for mentioning that too. Yes, people will take cash benefits for themselves and do things, but generally the intent and generally what I see is they reinvest it in the business. But you are
Yeah,
right. I always say you're not going to take your credit and go buy a boat.
yeah,
That's kind of my joke because you should invest it in the business because you want the business to grow. And that
yeah,
is its intent. Now, let's just say down the road you get a general audit and they find out that you got the ERC and the R&D credit and you used it just for personal gain to buy a house, buy a car, and you didn't put any of it back in the company, they're not going to look on that favorably. Okay.
Yeah.
I mean, it's allowed by the law, but
Yeah.
then they're going to find stuff that you don't want them to find, as I always say.
Gotta be very cautious. And with R&D tax credits, I am noticing that there is some increasing attention from the regulators around R&D credits. So, do you expect the IRS scrutiny to increase in this area?
Well, and we didn't finish this earlier. I think that what you'll see is that the audit rates are going to go up just a little bit. They
Hmm.
dropped very significantly post-pandemic, but
Yeah.
also again, the rules were in place. And if you follow the
Yeah.
rules, it's fine. Because the number one thing I see is that you provide the numbers to the IRS, but then they don't see the report, which is required. And a lot of people make the mistake of, we're not going to do a report. We have plenty of technical backing. What they do is the IRS goes fishing. They will send out a note saying, send us that report. And then you have to come up with one, whereas we provide it. Okay. And then yeah, we got to come up with them, but it has to draw what's called, they call it the nexus, which is a bad choice of the word, but to bring all of that legal accounting and engineering together with technical write-ups to show what you're doing on a day-to-day basis. Well, that being said, because there's going to be an explosion with the one big beautiful bill after July 1st, I think things are going to get back to normal. And then your chances are still low. But please remember that audit has such a negative connotation here. Okay. And I even opened it with after a year of being an internal auditor, right?
Yeah.
The reality is this is that the R&D audit is a technical team at the IRS made up of lawyers, engineers, and attorneys. Now, not to be rude to my IRS brethren, but they weren't exactly the A students in school. Okay.
Yeah.
So when they want to take a closer look, we defend and we end up educating them more of the time than they end up causing trouble. In 30 years, I have never seen an R&D audit trigger a general. Now,
Yeah.
in clarity, I've seen plenty of generals loop in the R&D credit, but they're already there. The main
Yeah.
thing is to make sure that the work is done right by someone who will back their work and someone that knows what they're doing.
Yeah.
That's why a lot of these pop-up firms they're very scary to me because as we review their work, we're seeing a lot of things that just frankly shouldn't be there.
Yeah. Yeah. True. 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 In fact, like you talked about the one big beautiful bill, and I know we certainly touched on it all, but just for summary purposes, because you've been in the industry for 30 years, you've seen it all. With the one big beautiful bill, give me like a quick rundown, maybe like a short masterclass on like what has changed in the R&D domain with the one big beautiful bill.
Well, number one, it got rid of that ridiculous 174 requirement, which again for 40 years was never there. And then 30 years, okay. I don't think they're going to make that mistake again. All right, because
Yeah.
the budget for the credit was dropped by 40% used because of that alone. Okay.
Oh.
Another thing the one big beautiful bill did was the cash incentive of do a superseding return, and then you can get the cash back for those years if you're under 31 million in revenue over 22, 23, and 24. That is the
Nice.
cutoff.
Hmm.
You can go back and get that cash. If you're over 31, you have to wait until 31 million, you have to wait until 2025 to take it, and then everything's back to normal. I think they've learned their lesson across the board, and it's just going to go back to normal of what it was for 40 years before they screwed with it. The only thing that's nice is that the credit itself, it's been, in 2016, President Obama made it part of the permanent tax code. It's become full law and it's going to be here forever because who wants to be the politician that kills innovation in the United
Yeah.
States? None of
Nobody.
them.
Nobody. True. 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 And it's irrespective. I mean, like nobody should. I mean, like, and innovation is something that's what makes us human, right?
Right. Well, and what's so funny is everybody was gung ho. You mentioned ERC earlier. Everybody was really gung ho on ERC. And then they were like, well, I don't know if I want to take ERC and the R&D credit. Okay, buddy, the ERC is a brand new program. The rules are not written really. Okay.
Yeah.
R&D has 40 years of history and case law. And so it's a much safer credit as long as you're working with the right partner.
Yeah, true, true, true. Now, before we wrap up, I always like to ask I would like to ask guests to leave our listeners with some practical guidelines. It's kind of like a a rapid fire thing. So I'm just going to ask you like two questions, one from the buyer side, one for the seller who is listening in. All
Sure.
right. So if you had a buyer listening to this episode, what is the first question you should ask regarding R&D credits during diligence?
Are they creating anything and are they paying taxes? Okay. Meaning, is there a tax bill either at the personal level or the corporate level? Because that's cash you can grab right away.
Brilliant. All right. And if there is a seller that's preparing to go to the market and is listening to this podcast, what should you audit internally before beginning a transaction?
Look at what you do that is creation based and slightly technical based, and give us a call to see if you can get that cash going before. Okay. Because remember, if you take it before the acquisition, they can't lower the value, they can only raise the value.
Yeah.
So the ideal world, the seller would grab this credit before the transaction started, because at that point it only ups the price. When the buyer does it, the buyer has more negotiation power. And that's what's been the pinch. This was passed in, the bill was passed in July. The guidance came out in September. So from September to July 6th, that's all we've got for these rules. Now, it'll slow down after July 6th, getting that cash back, but it could still be used in the M&A world for negotiation. Just people haven't thought about doing that.
Yeah.
And a lot of the R&D companies out there are afraid to enter this arena simply because of all these variables that we've already begun to understand and understand
Yeah.
more every day. So those variables are important, that you just have to look at all sides. I mean, if you were going to buy the building, you'd have the building inspected,
Yeah.
right? That's normal.
Yeah.
You should look at the R&D potential because it's normal. However, because of that hiatus in particular, people have forgotten about it.
True. True. All right. Now, before I let you go, Bob, first of all, this has been a fascinating conversation. I think one of the biggest takeaways today is that something many people view purely as a tax planning issue can certainly influence valuation, negotiation, deal economics, and so many other things. And for listeners who are listening in who want to learn more about your work or connect with you, which I predict would happen a lot, what is the best way to reach you?
Well, our website is all one word, thinktaxstrategies.com. And there's a landing page where you can fill in. They can also contact me. My phone number is there as well, but I'll say it here. It's 832-701-8508. And then my email is robert@thinktaxstrategies.com. So please feel free to, contact me at any time. I check junk every 10 or 15 minutes. So don't worry about that, where you're sending it from.
I like that. I like that. So, once again, Bob, thank you so much for joining us on Accounting M&A Insider. It's been a pleasure.
It's been a real
And
pleasure. I've enjoyed this conversation a lot.
absolutely, absolutely. And to our listeners, if you found this conversation valuable, make sure to subscribe, and so you don't miss out on future discussions on the strategies and realities behind buying and selling of accounting firms. With that, I bid you all adieu. Until next time, take care and keep innovating in everything that you do. Cheers.
Goodbye, everybody.
Access latest and trending CPE courses with my CPE One Unlimited Access subscription. Subscribe now.